Are you returning to India and think you can keep your NRI accounts running for tax-free interest as long as you don't stay forever? You're wrong. Under FEMA, your banking status often changes the day you land with the intent to stay in India for indefinite period. Because I see this pattern again and again. People return to India for a project or to support parents or to try the India life again, and they keep their NRI NRO account running because it feels convenient. But you might be breaking the law. Stick around because today I'm breaking down why nobody is watching is a dangerous assumption and how you can use a legal tax window called RNOR to protect your wealth instead. Hi, my name is Sagar Soman and welcome to another episode of the Offshore Advantage. Now let's start with the problem. First, why do people keep the NRI and NRO account running after returning? Because NRI is comfortable, interest on NRI savings and fixed deposits is generally tax-free in India, so long as you qualify as a non-resident under FEMA and the account is permitted to be maintained in that category and the account is easily repatriable. So the thinking is, I am only here for 1 or 2 years, why disturb anything? Then there is the remittance logic. As a resident, outward remittance is generally through the LRS or Liberalized Remittance Scheme framework with its annual limits. As a non-resident, people hear about the USD 1 million repatriation facility from NRO and start mixing the two in their head. And the third reason, and the most common one, laziness, disguised as practicality. I'll do it later. I'll update status when needed. I'll handle it when the bank asks. That when the bank asks moment usually comes at the worst time, when you are trying to make an urgent transfer, when you are closing a deal, when you are redeeming an investment, when you are traveling. Now here's the legal spine you must understand. FEMA is not income tax. FEMA is the foreign exchange rule book. Income tax asks how many days did you stay this year and what income did you earn. FEMA asks something else. Are you resident in India or not for foreign exchange purposes, and what accounts and cross-border transactions are you permitted to operate? And just to be clear, FEMA does have a day count concept. The base idea is to stay in India for more than 182 days in the preceding financial year. But in real life, the purpose of your move matters too, especially when you return for employment, business, or in circumstances that indicate an intention to stay in India for an uncertain period. That's why for banking compliance, banks typically treat the status change as immediate once you return for these purposes, and they expect your account categories and KYC to be aligned accordingly. And conversely, short visits without that intent generally don't change FEMA residential status. One more important clarification before we go ahead. FEMA is not saying that a returning person must liquidate all overseas assets the moment they become resident. FEMA permits residents to continue holding foreign assets that were acquired or held when they were non-resident, subject to the permitted framework. So this video is not about fear or forcing liquidation. This video is about something much more practical: account classification and compliance hygiene. Because banks don't see this as a theory, banks enforce it through KYC, declarations, and account categorization. If your address changes, your status changes, your FATCA CRS declarations are outdated, or your profile data doesn't match the account type, banks and brokers can restrict or block transactions. And here's the part most people underestimate. Once a transaction gets blocked, it's not solved by one phone call. It becomes paperwork, declarations, status proof, sometimes branch visits, sometimes weeks of follow-up. And yes, FEMA and RBI have a strict penalty framework. I'm not here to throw numbers at you, but to remind you that this is not a small procedural matter. Now let's shift from problem to solution. What should you do exactly? Step 1. Stop treating NRE as a lifestyle choice. The correct approach is always this: do the legal hygiene first, then do the financial optimization. If your FEMA status has changed, inform the bank. Get your accounts redesignated. In practical terms, that means NRE account should be redesignated appropriately once your status changes. That is not optional, it's compliance. Now you might ask, what about my NRE fixed deposits? Here's the clean practical answer. Most people do not need to break their NRE fixed deposits immediately on return. They can typically run till maturity at the contracted terms. But your bank needs to realign the account classification and your status in their records once your FEMA status changes. And on maturity, the proceeds can be parked appropriately depending on your plan and eligibility. Now let's talk about FCNR, because this is where smart planning comes in. FCNR can be a very elegant bridge when you are returning for 1 or 2 years. If you place an FCNR deposit while you are still an NRI, it can be typically continued till maturity, even after you return and your status changes. What does that achieve? Your money stays in foreign currency, so you reduce forced conversion risk, you reduce the I returned and the rupee moved against me regret, and then on maturity, you decide your next step. Convert to INR if you want to settle, or if you want to keep foreign currency exposure inside India, explore RFC where eligible, typically for holding foreign currency in India after return. Now, RFC or resident foreign currency account is useful but not compulsory. Think of RFC as a foreign currency pocket inside India where eligible. If you already have a functional overseas banking setup, you may not need RFC at all. So the decision is practical. Do you need foreign currency inside India, or do you prefer to keep foreign currency outside India and only bring what you need? Now let's address one more thing. Many NRIs focus only on bank accounts and forget investments. This is where real pain happens. You do the bank redesignation, but your demat, mutual funds, broker, KYC all remain in a mismatched status. Everything looks fine until the day you try to sell or redeem. Then your broker asks for fresh declarations, or the platform restricts your transaction, or the AMC insists on re-KYC, or your bank mandate doesn't match. So if you're returning even for a short period, treat this as a complete alignment exercise. Bank accounts, demat, mutual fund folios, broker status, KYC, nomination, mandates. Now I want to pause here and give you something very practical. If you are in India for 1 or 2 years, you have a golden opportunity that most NRIs waste. Use India as a compliance reset window, because many fixes are easier when you are physically in India. OTP issues get reduced, biometrics work, branch visits are possible, name mismatches can be corrected. So while you are here, do this. Update Aadhaar mobile, align PAN and Aadhaar name spellings with passport, fix CKYC issues, update bank KYC, update broker KYC, update nomination details, and don't ignore FATCA CRS declarations. Many banks and brokers can restrict transactions simply because these are pending or outdated. If you fix it while you are in India, you avoid nasty surprises later. And trace your forgotten buckets, EPF UAN accounts from early career, NPS login that nobody remembers, old pension or superannuation accounts, insurance policies where the nominee is outdated. This is not paperwork for its own sake. This is what prevents the classic NRI disaster. Everything was fine until I tried to redeem or claim. Now let's come to plumbing of everyday life. When someone returns to India, they open a salary account, but they forget the mandates. SIPs, EMIs, insurance premiums, credit card auto debits, standing instructions. One EMI bounce can create a credit report issue. One premium bounce can create a policy lapse. One failed mandate can create late fees and complications. So when you are setting up your resident salary account, do a quick auto pay health checkup. It sounds boring, but it saves you drama. Now another practical point NRIs confuse: nominee versus operator. A nominee typically helps in transmission on death. It does not automatically solve day-to-day operational issues. For day-to-day operations, bank typically requires a mandate, joint holding where appropriate, or a documented power of attorney route that the bank or institution recognizes. This one correction prevents most panic calls later. Now, before we move to the tax transition window, let's address the mistake question. What is one mistake NRIs must absolutely avoid? Letting convenience override compliance. This is the line where many people justify non-compliance. As a resident, outward remittance is limited, there is TCS. As an NRI, I can use the USD 1 million route later, so I won't convert. That's not how the system works. Different windows apply to different statuses. You cannot keep the wrong status just to access a preferred remittance route. And one more reality check: the USD 1 million repatriation facility is not a hack, it is a compliance lane. It is documentation heavy, bank paperwork, tax compliance proof, CA certificate, clean money trail, and in many cases, the bank will ask for tax clearance and supporting certificates where required. So the right approach is compliance first, optimization second. Now let's come to the part I teased at the start, the loophole. I'm calling it a loophole for attention, but let me be very clear. This is not a FEMA loophole. RNOR does not give you permission to keep an NRE account incorrectly. RNOR is a tax transition window. FEMA decides what accounts you can hold. Income tax decides what income is taxable. and these two can move on different timelines. So what is RNOR? RNOR stands for resident but not ordinarily resident. Many returning NRIs may qualify for RNOR status for a limited period depending on their travel history. And during that RNOR phase, Indian tax law typically taxes a narrower scope compared to ROR. It generally covers India sourced income and, in specific cases, income from a business controlled or a profession set up in India. It is not no tax, but it is a softer landing than full ROR status. Now connect this with FCNR. During RNOR, interest on certain RBI approved foreign currency deposits may remain exempt in India under Income Tax Act, subject to the conditions. So a well-planned return can look like this. FEMA compliance is clean from day one, accounts aligned properly, FCNR used as a bridge where suitable, RNOR used as a tax transition window where available, documentation kept clean. Now let's answer the last question properly. How is foreign interest and investment income taxed when you live and work in India? It depends on your income tax residential status for that financial year. If you are a non-resident, India generally taxes India sourced income. If you are a RNOR, foreign income is not fully pulled into India's tax net except in specific situations like income from a business controlled or a profession set up in India. If you are ROR, India taxes global income and expects detailed foreign income and foreign assets reporting. Now the biggest panic line I hear is if I transfer my foreign savings to India, will India tax it? No. Remittance is not the same as income. Moving money changes where it sits, not what it is. Remittance doesn't create income, it only moves money. Tax depends on your residential status and the underlying nature and source of that money. The real risk comes from poor documentation and from people waking up late after they have become ROR. Now, how do you legally minimize double taxation? Two steps. First, apply the DTAA article for that category of income, interest, dividend, capital gains, whatever it is. Second, if tax is paid abroad and income is taxable in India, claim foreign tax credit with the proper reporting and documentation, including Form 67 process and related schedules. And here's the key line that makes your life easy. Foreign tax credit is won or lost on paperwork. Keep foreign tax withholding certificates, annual income statements from banks and brokers, proof of tax paid abroad, country-wise breakup. If your trail is clean, this becomes a compliance exercise. If your trail is messy, it becomes an anxiety exercise. Now let's conclude. If you are an NRI returning to India for 1 or 2 years, do not treat it as a casual pause. Treat it as a status change event. FEMA compliance first, bank account aligned, investment aligned, mandates aligned. India side reset done when you are physically here. Then and only then optimize tax using the RNOR transition window where available and structures like FCNR where suitable. Don't bend FEMA to solve a remittance inconvenience. Solve your remittance inside the correct FEMA status because the cleanest exits are always the ones that started clean. If you found this useful, share it with others who are planning a temporary return to India. This one mistake, keeping the wrong account category, can cost months of follow-up later.